Yes, we are favoring 30-year duration in Korean bonds, and obviously today's decision was a hold. And as you mentioned previously, the BOK's cut in September is still on the table. I think in the market, the expectations for further monetary easing will be there, and so that will keep the bond yields pinned down. Now, we have both political and economic uncertainty in Korea rising at the moment, and we've seen various data, economic data come out lately that is suggesting a further downward adjustment in growth forecast for this year. Let's say consumer sentiment index, we've seen that plunge last month, and unemployment rate that came out yesterday saw a huge spike in December. So even though that was partly due to possibly a one-off factor, such as the halting government-sponsored programs, but the unemployment rate in the age group of 15 to 29 also rose quite substantially. This suggests that companies are reluctant to hire fresh graduates, and also reflects that major decision-making processes are getting delayed in the midst of political and economic uncertainties.
But I think one of the reasons why many folks are expecting not an aggressive rate-cutting cycle, at least for the year, is the possibility of an extra budget, a fiscal stimulus. No matter what happens on the political front, and that we will get some kind of support. Couldn't that risk your position?
Yeah, that is the major risk to our long duration position. And given that the KTB issuance, net issuance for this year is expected to increase by more than 60% compared to last year. And on top of that, having supplementary budget will be a pressure on the bond supply side. Having said that, something that the decision that came out last year was the inclusion into the WICB index. Now, the actual inclusion will not be until November, but I know that investors are looking into going into Korean bonds ahead of the inclusion date. So some of that supply pressure will be alleviated by some of the foreign demand coming out of the WICB index tracker.